Hello, fellow traders. 'Tis I, the Rumpled One. It is Wednesday, March the 20th. The year's 2019. Let's talk trading, how to trade like a pro, concepts. You may have seen some of my other videos or watched some of my other videos and heard me talk about concepts and trading myths. And the reason I brought up concepts again is I was watching another trader's video, and he was talking about the gambler's fallacy. And for those of you who don't know what the gambler's fallacy is, it simply is a invalid concept that if you flip a coin, say 10 times in a row, and the first 5 come up heads, well, then the next one, odds are it's going to come up tails. Well, see, that's false, because each flip of the coin is an independent event. Doesn't matter what happened before. The odds don't change. It's either going to land heads or tails, right? Unless it lands in a crack or somehow the bounces and it lands on its edge, but we're not going to count that because, that's not the idea. It's going to either land heads or tails. But in trading, you see, it's slightly different because the outcome of your trade is independent of the outcome of your last trade. But in trading, you have to remember sometimes there's herd mentality. So if there's a stampede and price is going down and you get in early in the stampede, then you've got a pretty good chance of having a profit. But overall, your trade is independent of everybody else's trade, including your previous trades. So it's one of those things where there's some truth to it, but then there's also the bigger picture, the reality. I mean, of course, there can be that one trader who thinks, oh, it's low enough now, I should buy rather than short. And you don't know who that trader is or when that trader is going to show up, unless it's you. So the point being is, trading, there are no odds. So there are no probabilities. All there are the statistics of previous trades. But once again, we stated, for the most part, they have no bearing on the outcome of the next trade. So you might think this sounds a little convoluted, and that's okay. But if you ponder it, you might see it the way I see it. So for example, if you're trading a wick zone trade and price is coming out of the wick zone, it makes sense to go in that direction. Now, you're not going to win every time. I've established that. But that's what usually happens, is you'll see other traders will be trading out of that wick zone. And we can move forward and we'll talk about the risk and money management of the trade, because this is what will give you the confidence. And you see, that concept of confidence, what's that based on? Well, it's usually based on what's happened in the past. So if you've had a successful trade and then another, you're pretty confident in trading. But if you've had loss after loss, your confidence in trading might be shattered. Point being is that so long as you're employing your money and risk management on each and every trade, you already know the most you can lose on any particular trade. So that gives you the confidence to go ahead, push that button, click that mouse, enter that trade, and see what happens. Hopefully, you'll have the opportunity to take a profit. Now, I was just talking about that wick zone, and as you can see here, we're popping out of that wick zone on the euro yen. And for those of you tuning in late this week, all the gaps, opening gaps have filled. So right there, you have the confidence to go long, and you can see others are joining in that movement. Oh, and by the way, we've got FOMC coming out today in a few hours. So let's be careful trading. And the reason I say be careful, because even if you have your stop losses, but sometimes during these news events, price can jump through your stop loss and you can take a bigger hit than you plan. So sometimes people stand aside during the opening of the announcement and then they'll jump in and trade. Just a heads up. But most of you probably knew that anyway, right? So you can see we're still red on the month right now. And you can see here we are entering the opening range for the first day of the month. I'm sorry, first day of the month. We're entering that opening range. So here's the high of the first day of the month, low of the first day of the month. And you can see first day of the week so far, we've been pretty much inside that range. So once again, using these horizontal lines as breakout trades, is showing us profits. Or the opportunity. Right here, opening day of the month, you see we're having a hard time closing above it. And seeing the opening ranges for the last 12 months. You can see here we're just 1 pip below the low. Yesterday, there was once again an opportunity to take that breakout trade on the daily inside bar. You can see here 2 pips above the weekly inside bar high. So inside bar trades are proving to be profitable. Yesterday high, you see we broke through it. Now we've pulled back, exiting that wick zone. But you can see the range is really down here. All the action seems to be on the British pairs right now. And you can see they're all down from the open. Last hour we had the weekly H1 highest open. Oh, let me for those of you wanting to know about the strength indicator over here, once again, it's this indicator that I modified. And this is one of the modifications that I added, where you take the euro and the dollar. I'm sorry, in this case, the euro and the yen, and it tells you the direction based on the strength, which way to enter the trade. Buy zone, okay, we had the pivot. Looks like we missed it. This is the open. Did not go towards the pivot, but once again, the pivot was inside between the buy zone and the short zone, so that was no bias. Pivot needs to be outside the zone. The further away, the better. That gives us a stronger bias. You can see here we had an entry in the buy zone right out in the third hour of the day. Proved to be profitable. We had a pro trade here, pro trade here. Right now, you can see you're giving back a couple of the pips, but it's still profitable. No rat zone, only 28, 29 pip range. That's not enough. In fact, that just gave me an idea. I haven't modified this indicator in I don't know how long, probably a decade. But what I could do is I could put in an input minimal range, and if the minimal range hasn't hit, it won't even show the rat zone. Maybe it'll just give a message, minimal range has not been exceeded. Let me know what you think about that idea. And it might also give me the opportunity, now that I think about it, actually, I could put the distance prices away from these levels. I'll have to think about it. I've got reason I haven't been coding as much. I've got other things that I've been involved in. I think I might have told you. So, and it's springtime. Got to get outside at the ranch and do some outside chores. Okay, once again, we missed that pivot. Might hit it today, though, since FOMC is coming out. And you can see here, we missed the pivot by just 7 pips. So we've got a couple of pivots that are waiting to be taken out. Okay, price action. You guys know about price action, so I'm going to skip this one today. Wick zone, in and out, you can see. Sometimes you get a little, sometimes you get a lot of pips, that is. And you can see here pretty much the same action, hitting that weekly high, which was 125.56. So we're just 1 pip above it at the moment. And you can see here, price is just oscillating in about a 2 or 3 pip range. Not much happening at the moment. And you can see that reflected on this M1 chart. You see you got a trigger. And then you got another trigger there. So you just have to wait and see if you get stopped or if you get to take a profit. So that's it, fellow traders. Just remember, when you hear these different concepts, take some time and really think about them. Dig in there deep and see if you can find out if there's really a fallacy in their thinking. Just don't accept things at face value. And remember, it's not what you trade, it's how you trade it. So get out there and drain the banks